Silicon Valley built a trillion-dollar empire on four simple words: move fast, break things. And when the blockchain boom hit the 2010s, developers imported that exact same philosophy, racing to capture market share by shipping code as quickly as humanly possible. That approach worked perfectly for generating early hype and raising billions in venture capital. But deploying live financial infrastructure at breakneck speed carried a brutal hidden cost. This chart illustrates the consequences. Over the past 5 years, hackers drained $2.5 billion strictly by exploiting vulnerabilities in cross-chain bridges, code that was rushed to market before it was bulletproof. Rushed code was one failure. Economic design was another. Many systems were built with incentives that favored early private investors over the general public, creating a second layer of instability. Look at this pie chart of the $97 billion in token supply scheduled to unlock in 2025. $19 billion of that total is designated specifically for venture funds and insiders, creating immense pressure to sell onto the open market. The early crypto consensus was highly efficient at generating short-term profits for early backers, but proved fragile as a foundation for sustainable global financial infrastructure. Right in the middle of that frenzy, one network took the exact opposite approach. Cardano rejected the obsession with speed and venture capital entirely. Instead of a private presale, they held a public offering. Instead of rushing to launch, they subjected every piece of their architecture to rigorous academic peer review and slow mathematical verification. The rest of the industry treated them like a punching bag. The process was widely dismissed as too academic, as hopelessly rigid, and far too slow to compete. Now, the market is seeing a reversal. As rapid deployment models struggle with code vulnerabilities and insider sell-offs, major networks are beginning to adopt the same high-assurance methods they once dismissed. The existential security threats of managing billions of dollars are forcing a reset across the entire blockchain ecosystem. The first shift is how networks ensure their code is safe before it ever goes live. This flowchart demonstrates formal verification, using a strict multi-step mathematical filter to prove code works as intended, eliminating vulnerabilities before launch. Now, look at how this applies today. Ethereum is updating its multi-year roadmap to make this precise verification process a priority. Ethereum researchers are exploring a transition toward the specific style of data storage architecture Cardano uses, though completing that structural change will take years. The trend is clear. The focus is moving from shipping code as fast as possible to ensuring it is mathematically sound before large sums of capital are at risk. Then there is the problem of total on-chain transparency. A public ledger is a useful concept, but default visibility makes it difficult for banks and hospitals to use the technology without exposing sensitive data. This illustrates Cardano's selective disclosure via its Midnight chain. The data node is opaque by default, generating mathematical proofs allowing regulators to verify transactions without exposing private details. The broader industry is following. Ethereum recently assigned a team to tackle privacy, targeting a 2026 update. Other major players, like Ripple and Sui, are also working to add their own confidential transfer features. The industry is realizing that selective, regulated privacy is a requirement for institutional adoption, rather than an optional upgrade. The third correction involves how networks distribute their supply to the market. Early network launches often relied heavily on venture capital. Solana, for instance, raised over $300 million from private investors. Cardano, by contrast, funded itself through a public sale with no venture allocations. Today, heavy insider holdings are increasingly seen as a liability. High concentrations of venture supply can lead to sustained selling pressure that erodes retail trust and suppresses growth. This side-by-side comparison shows the shift in strategy. Rather than funneling supply into a venture-heavy center, new projects are bypassing private fundraising to ensure vast percentages of their supply are dispersed directly to active users. Building long-term user trust requires an equitable, public-first approach to economics, rather than a reliance on private equity. This convergence doesn't mean Cardano has won the market in terms of daily users or price action. They are still competing against massive ecosystems for dominance. However, the architectural debate is evolving. The trade-offs Cardano chose, slow, verified, and public first, are increasingly viewed as the necessary baseline for institutional trust. Building a standard web application allows for trial and error. Building global financial infrastructure demands a strict measure twice, cut once philosophy. As the industry matures, it is using the very principles it once dismissed as its roadmap for survival.